Everyone. Welcome to Kristine Garcia's final defense. My name is Dr. Perez, and I will be here providing you with the information about Kristine's defense. And I just wanted to welcome everyone to her defense. And first and foremost, I wanted to thank our committee members for all their help and support in helping to get Kristine to this point, this milestone in her dissertation process. She has worked very hard and has been very diligent in getting to the point where she can now defend today. So, with that being said, what I'd like to do is introduce Kristine, but first, just some housekeeping. We will go through the defense. Kristine will present. Then at the end, we'll have a question and answer session. The committee will ask her questions, and then once the committee is complete with the questioning, then we will open it up to any of our esteemed colleagues that are currently joining us. If they wish to ask any questions, they're more than welcome. Then once we have concluded, then we will either place Kristine in a waiting room or have her step away. The committee and I will deliberate, we'll return with a verdict, and then we will share that, and then the presentation and the defense will conclude. So with that being said, I would like to introduce Kristine. Kristine, this is your day. This is what we've been working so hard to get you to. So take it away.
Okay. Thank you, Joe. Very much appreciated. And I also would like to thank my committee, Dr. Bill Bateman and Dr. Kevin Parlett, and of course yourself, in helping me get here. It has been a journey, as we all say, but I'm excited. I'm ready, hopefully. The topic of my dissertation is financial reporting transparency and the impact it has on a firm's cost of debt. And it's a case study of the public automotive supplier industry, and it is a quantitative study. A little bit about myself, in case you don't know me. I received my bachelor's from Northwood, my master's in finance from Wayne State University, and I'm a DBA candidate. I started the program in 2020. I'm also a finance professional with over 30 years of finance and leadership experience in the automotive manufacturing industry. So it's an industry near and dear to my heart. I have experience with large public firms, SME, and private equity owned firms. And I'm driven by a passion for continuous learning in both the professional and academic worlds. This is the outline of the presentation that I'll be sharing today. Some of this we have covered in the proposal defense a few months ago, so I'll go quickly through some sections, spending a little bit more time on the introduction, just to restage the introduction to the study, the problem statements, and the importance, significance. I'll probably move more quickly through the review of literature, that we spent a lot of time on that in the previous review, and then move into the methodologies, findings, and discussion of results. The introduction to the study. So there was a significant body of both theoretical and empirical research surrounding the importance of transparency and the impact that it can have on the firm. I've noted one of the key authors of Barth and Schipper here that did a handful of literature, and some that you'll see footed later as I move through. The theoretical research suggested that that increased reporting transparency could reduce information risk and asymmetry. And the empirical research confirmed that by providing evidence of an association between the transparency and cost of capital for firms. So what is transparency? That was some of the early literature, is just trying to define it. The definition I'm sharing here is a combination from Barth and Schipper and Cynthia Glassman, who was the SEC commissioner from 2002 to 2006. They define it as timely, meaningful, and high-quality financial and information disclosures that convey a firm's underlying economics in a way that is understandable to users of their financial reports. And the topic really gained momentum in the early 2000s when we had multiple crises happening. From 2000 to 2008, there was some significant incidences. So there has been a continued focus on transparency, and it's continued to evolve and be a relevant topic. A couple of key terms and definitions. Information asymmetry, excuse me one second, which Healy and Plipu discuss, is the information gap between insiders, company insiders, and external stakeholders. So when there is that imbalance, you'll have information asymmetry, and you'll tend to have lower transparency, the higher level of asymmetry. And then some variables that I'll touch on quite a bit later, so I wanted to frame here, is the innate versus discretionary components of accruals quality. This is a concept that was introduced most notably by Francis et al. In their 2005 study, which is noted frequently. It's a key research article on this topic. So that they define it as the innate portion is driven by fundamental business factors that are in line with the underlying economic activities of a firm. And this includes variables noted here as size, the variability of their sales and cash flow, the length of their operating cycle, and incidence of negative earnings. And these key factors you'll see later in the findings, and they were part of the regression analysis. And then the discretionary portion is the portion that's driven by management choices and actions. The statement of the problem, prior empirical research confirmed the link between reporting transparency and the benefit of a lower cost of capital. However, the scope of the prior research was expansive in size. There were 6 key studies that used very similar methodology that were referenced in my research. But they tended to provide single country focus. And as I said, they're expansive in size. They averaged 24,000, slightly over 24,000 firm-year observations, and spanned an average of 14 years and covered multiple up in average of 9 industries. And I've noted the key authors for those 6 studies in the third bullet. But the prior studies did confirm the link between the cost of debt. And they also used accruals quality as that metric because transparency cannot be measured itself. There's a handful of proxies that are used in quantitative studies. I use the AQ proxy for measuring performance of a firm by mapping accruals into cash flow. And then cash flow because it's a reliable measure of a firm's financial health. And when accruals quality is high, it enhances the credibility of the financial statements to the stakeholders. The purpose of this study was to take that expansive scope and narrow it to the automotive manufacturing supplier industry. My goal of focusing on one study is to provide insights to a specific stakeholder group with the goal of offering actionable insights that can be used to enhance their decision-making related to transparency within their organization to drive a favorable impact on their cost of debt. The significance of this study is to help firms become more aware of the potential significant economic impact that their level of transparency can have, and it provides an opportunity for them to close the gap in performance, if it exists, to benefit the firm. From a regulatory standpoint, it provides the opportunity to allow stakeholders to make informed decisions, enforce regulations, and develop relevant and effective standards. The research questions posed in the study are, do firms with higher accruals quality have lower cost of debt than firms with lower accruals quality? Does financial reporting transparency measured via the accruals quality metric have a favorable impact on a firm's liquidity during times of crisis, as realized by a lower cost of debt? And then separating the accruals quality into the two subcomponents of innate and discretionary, is there a difference between the two? I'm going to skip through the hypotheses as we'll revisit those in the Chapter 4 findings. Just for brevity, since this has already been covered, just a reminder. The conceptual framework, just to touch on this brings together the key elements from the definition of transparency. And you can see here that it highlights the timely, meaningful, and then the benefits to the firm that I've touched on. So this is just a graphical representation of those key elements. And then the theoretical framework that was presented in the proposal review goes a little bit deeper and ties those into the key variables in the study. So again, moving quickly through these, we've touched on the reporting transparency definition. What is it? Other key concepts that were in the literature review touched on corporate governance. This was discussed by Armstrong, the author Armstrong, is that it plays a key role in the level of transparency of the firm, as whether it's built into the corporate governance structure. And then there was a lot of time spent reviewing disclosures. Corporate disclosures, voluntary or required, and evolving with CSR, ESG, are the way that the information is shared. So again, that if it's symmetrical, those disclosures are equal between internal and external stakeholders. And Healy and Pleipu were noted before, and they're a key author in that topic. And then the quality, of course, if you disclose it and it's not high quality, then it's not going to benefit the firm. So also touched on in detail and highlighted by Arthur Levitt from the SEC, accurate and transparent reporting is crucial for compliance and integrity. So those were the key concepts in the lit review. Measuring financial transparency. So I've touched on this one. I did select the accounting-based measure, but measuring financial reporting transparency is a key construct in the study, and Barth and Schipper shared this table with these metrics. The accounting standard was selected due to its strength in assessing financial reporting transparency, as it directly affects the quality, comparability, and reliability of financial information. The market-based measures are generally focused on stock return data, and then analyst measures based on a database that has analyst information, actuals versus their projected results. So the accounting-based measure was the most relevant for this study. For the economic periods, I worked backwards, starting with 2022, which was the most recent financial year of data available, and working back, I wanted to capture a longitudinal, very long period of time for this study, which is consistent with prior studies. So I went back 30 years. A minimum requirement is 7 years of data for a firm because of the requirement of 5 with a look back and a look forward to calculate the accruals quality. And I can touch on that formula in a few slides. For the automotive industry, it was selected because it's significant in terms of GDP for both the US and Europe at 3% and 7% respectively. It also employs a significant number of people in both the United States and Europe, and it was impacted by the crisis that occurred in the time frame of the study. And I've noted a few of the key OEMs that were affected, but suppliers were also significantly affected. Jumping into the methodology. I'll touch on some of these slides because there were some changes after the data was collected that I'll highlight. So nothing changed with this basic methodology. It's a quantitative longitudinal study. It aligns with the scope of analyzing historical firm data, which was my 30-year period, and it's consistent with prior empirical research on accruals quality and cost of debt. The linear regression was used as allowed for observation of the impact of multiple variables on the cost of debt. In addition to the strength and direction of the relationship observed and the correlational analysis that was completed, a linear regression allows for a deeper understanding of the relationship between the variables and the observation how changes in one variable can impact or might cause changes in others. It also provides the ability to quantify the relationship by showing how much a one unit change in the independent variable is expected to change the dependent. The linear regression were utilized to derive empirical measures for the variables that I've noted, AQ, the innate AQ, and discretionary. And then there were 5 regressions run, a cost of debt baseline analysis, and then a cost of debt with crisis variables included, and a cost of debt with innate and discretionary. And I'll touch on those in a few slides also, in a little bit more detail. And then additional statistic analysis was used to analyze the firm data and answer the research questions and hypotheses. For the sample, I've added some information on this slide. The target population was the top 100 automotive manufacturing supplier list that's published annually from Automotive News. It is a global data set. Just some general information. Japan was the highest country count, coming in with 18 firms incorporated in Japan, and the lowest average cost of debt at 1.8%. The US was the second highest company with firms in the sample, with an average cost of debt of 6.95, so right around 7%. Brazil had the highest average cost of debt at just over 7%. And you can see a handful of single-digit countries: Brazil, China, Cayman Islands, Great Britain. Very concentrated in Japan and the US. The final population was 51 firms of the top 100. There were adjustments made looking at the sample selection method. In the proposal defense, I had estimated 71, and that was primarily excluding private companies because of the concern of availability of data for the longitudinal long period. But adjustments were also made for public subsidiaries, some public subsidiary firms, and then firms with missing data or insufficient years, not meeting the 7-year requirement. The G-Power sample tool, analysis tool online calculator, was used to assess the sample size, and putting in the data into the tool with an effect size of 0.5, an error probability of 0.05, the power factor of 0.95, and the number of predictors from the baseline cost of debt regression, which was 9, returned a required sample size of 29, which indicates that the 51 firms in the final sample met that criteria. The data collection. The data was retrieved from WORDS, the Wharton Research Data Services, and this is consistent with the proposal. It was taken from the CompuStat Capital IQ database, which is part of the S&P Global Market Intelligence. The guest access was provided by Grand Valley State University. And I was able to retrieve some missing data for Dana. They're a larger organization in the sample data set, and that was retrieved from Edgar from sec.gov and their company website. Cross-referencing those two, I was able to fill in a few years of information. I was not able to do that for other firms with missing data. The dependent variables and independent variables are consistent with the proposal. The data was, both financial data and some descriptive data was downloaded into Excel, and the required calculations were either done in Excel or in the statistical software, which I used Jamovi. For descriptive statistics, I do want to note on this slide that Windsorization was intended for the data at the time of the proposal, But after the collection was completed and the data was analyzed, due to the smaller sample size and the limited number of outliers and the primary cause of the outliers, I did not end up Winsorizing the data because a lot of the outliers were due to the cost of debt somewhat surrounding the crisis period, which was the goal. I wanted to capture that in the study because I was trying to understand the variability. So the data was not Winsorized as originally intended. And then in the second bullet here, I note the 5 linear regressions that were run in a little bit more detail. I touched on the cost of debt baseline, the cost of debt with crisis, the innate and discretionary. There's a regression run to actually create those variables, and then the regression run against the cost of debt. So it's a 2-step process to calculate. So it created two additional regression analysis into the models. For statistical output, I've got a little bit more detail on the third bullet about the different analysis tools that were used. The Pearson correlation matrix was used. Model coefficients were reviewed along with the t-statistics and p-values. And then also collinearity test with review of the variance inflation factor. And ANOVA for the cost of debt, crisis variables, and crisis and AQ. And then residual scatter plots on the cost of debt regression variables to assess heteroscedasticity. And then histograms, bar charts, and box plots were used to assess normality. This slide shows the specifics of the regression models used in the study. So as I noted, the first item is a regression using the total current accruals against the cash flow as discussed with the change in revenue in a PPE variable. This regression actually creates the AQ variable that's then used in the next cost of debt regressions. And then the fourth regression creates the innate variable. So using those specific innate characteristics of the firm, size, standard deviation of cash flow and sales, their operating cycle and negative earnings will create the innate and discretionary variables to use in the final and fifth regression on cost of debt shown here. Moving into findings. So this slide shows the table for the Pearson correlation findings. The correlations were generally consistent with the prior empirical studies, Francis in Iliwa studies that are noted next to the bottom right of the table. There were 4 key ones that I've circled in blue that stood out in the correlation findings. There's a moderate association between the cost of debt and accruals quality at 0.418. And this is due to an increase in cost of debt resulting in an increase in accruals quality. And as accruals quality increases, it actually represents a lower quality of accruals. So that's a positive linear relationship. And then cost of debt and the standard deviation of net income before extraordinary items, which is the NEB notation, is also moderately positive, indicating that as the cost of debt increases, the variation in that net income is going to increase also. There's a moderate association between AQ and the net income, or the NEB, at 0.6, so a little bit stronger, indicating, again, that as accruals quality increases, or the AQ variable increases in the decile ranges, net income variability increases. And same with leverage, only this is a negative linear relationship. As leverage increases, indicating that a firm debt level is increasing, the variation in net income increases. And this is expected due to the impact of carrying higher debt-related cost. The Pearson correlation was useful in providing the ability to quantify the strength and the direction of the linear relationships, specifically to the 4 that I've highlighted. And it was simple and easy to interpret, and it was used in specifically the 6 empirical studies that I've referenced. Looking at the cost of debt descriptive statistics, this shows that in table 1, you can see I've broken it out into all years, and then in the different, I call them crisis periods. There's a pre-crisis, crisis, and then post-crisis. So the cost of debt analysis for all years in the study reflects a 0.0402, which is 4.02%. And then looking at the average cost of debt going down the mean column, by crisis periods, the average is increasing. So starting in pre-crisis, it's 5.04% to 4.99, and then post-crisis, it drops to 3.41, respectively. So interesting to note that the cost of debt was decreasing over the period of the study, and this is consistent with the overall market rates for debt during this time, based on an offline analysis that I did for the LIBOR rates, the London Interbank Offered Rate. The average pre-crisis LIBOR rate was 4.3% during the crisis, dropping to 1.4, and then post-crisis 0.8, with a few fluctuations in between. So the movement is consistent with the overall market with the decreasing debt. An interesting item to note in table 1 is that the variability was greater in the crisis period. You can see the max min is actually at 50% variability, and the pre and post crisis are closer to the low 30%. So definitely greater volatility during crisis. This does include outlier data, as I mentioned, for Visteon and Dana, who each filed for bankruptcy, one in 2006 pre-crisis and one in 2009. And then there was another firm that had a debt restructuring in 1999, which was kind of pre the early 2000s crisis cycles, but still debt related. In table 2, I've introduced the decile measurements. So the AQs were grouped into 10 deciles based on 995 observations. They're in 10 deciles, sorry. And decile 1 represents firms with low accruals quality, with low AQ, high AQ in decile 1, and firms with low AQ in decile 10. So you can see the higher quality firms have the lower cost of debt at 2.08%, and lower AQ firms are in decile 10 with a higher 7% cost of debt. This results in a delta between the high and low of 4.9%. The data by decile was not monotonic due to the variability within the data set. Descriptive data for the broader data set. So I know I've got a lot of variables. There were a lot of variables in the study. I won't touch on all of these. I'll try to touch on the key few. So AQ is shown on the top row, and the average for AQ was 0.0113, with 80% of the AQ values falling within a range of 0 to 0.033. With generally higher AQ values in both the 75th and the 90th percentile. Prior studies average AQ value for the 6 empirical studies that I've referenced is 0.0479, so much closer to the higher percentile for the automotive industry data. The cost of debt we just touched on. For firm characteristics, what are the size and sales for these firms? The average firm size based on total assets in the sample data set is just under 10 billion at the 9667, and it ranges from 1.5 billion to up to 28 billion. Sales, a little bit similar range, average just over 10 billion with a range of 1.5 to 30, with the top 10 sales represented by 3 companies. Independent variables for leverage. These variables are used primarily in the cost of debt regressions. Leverage is the total interest-bearing debt ratio to assets, and the average is 0.07 with a range of 0.0072 to up to 0.1779. So a significant range on the leverage side and the amount of debt these firms are carrying. From a size perspective, the log of total assets was used to represent the size of the organizations. This represents an indicator of economic power, and the log was used on most variables to normalize the sample data set. So the average here is 3.7 with a range of 3.2 to 4.4. For return on assets, this represents how well the company is utilizing their assets, with an average of 3.3% and a range of negative 0.8 to 8%. So also for ROA, a significant range for the automotive firms. And interest coverage represents the coverage a firm has from their earnings to pay their interest cost and service their debt. The average for this is 40, and with a range of 4 on the low end and 87. So quite a range on the interest coverage variable also. And then the standard deviation of net earnings is a measure of the volatility of the earnings. And that range, it averages 0.04 with a range of 0.18 to 7. The items below represent the innate variables that I've touched on. And just for brevity, I'm going to move through those a little bit. I'll try to go through these quickly. I have these innate variables again are related to the economic fundamentals of the firm. The standard deviation of cash flow is a measure of volatility of the firm's cash flow. With an average of 0.05 and a range of 0.02 to 0.07. Sales, or the standard deviation of sales, again, is a measure of volatility of the firm with an average of 0.38 and a slightly wider range at 0.14 to 0.66. Negative earnings was the incidence of negative earnings of the firms during the sample period, how many times they had negative earnings. And the average was 3 with a low of 1 and a high of 7. The operating cycle represents the average, or the AR days plus inventory days. The average was 161 with a range of 68 to 250. And then the log of operating cycle was also calculated to reduce variability. So all of that leads us to hypothesis 1 findings. The hypothesis here is there is no difference in the cost of debt with firms with poor AQ versus firms with good AQ. And the regression results show that the R value of 0.493 shows a moderate linear relationship. The R squared shows the variables explain 24% of the relationship, with no significant change in the adjusted R squared for the addition of variables. And the p-value does show that the cost of debt and AQ relationship is statistically significant at less than 0.001. The t-statistic is also significant or strong at 6.67. And the f value not shown is 44.5, which indicates a strong relationship consistent with the p-value and the t-statistic, and it indicates that the model is a good fit for the data. These results are statistically significant and confirm there is a difference in the cost of debt for the firm based on their AQ. Therefore, the null hypothesis is rejected and the alternative accepted. Moving on to the second hypothesis. This hypothesis states that there's no impact on a firm's cost of debt during periods of crisis for firms with high level of AQ. And the regression results show that the R value of 0.591 shows a strong linear relationship, stronger than the base cost of debt regression just shown. And the R squared increases to 35% explanatory power compared to the 24. Again, with no significant change in adjusted R squared. The p-values show that the results are statistically significant, again, with the exception of the crisis variable. And this is possible when you introduce an interaction variable, which is done with, you can see the crisis and the crisis times AQ. So crisis times AQ is statistically significant, whereas crisis is not in this model. And the T statistics are also significant at 11.74 for accruals quality, AQ, and then crisis times AQ is a negative 0.9271. And the negative value indicates that as the crisis period times AQ increases and we move through, the cost of debt decreases. And this is consistent with the data that was indicated in the prior tables with the movement of the debt. Looking at the data broken down by decile and the crisis periods in more detail in this table, you can see that the AQ deciles, as I noted before, were assigned in groupings, the data into 10 groups based on the data set of 995 observations. This data shows the average cost of debt movement for the high quality firms goes from 2.9 to 2.8, and I have it circled in blue there. And this confirms that there is an impact, although minor, based to the AQ decile during the crisis period. Therefore, the null hypothesis is rejected and the alternative accepted. However, there's some other items to note with this information. What the table is showing us is that there's less variability in the crisis impact for high AQ firms. You can see, as I noted, for AQ decile 1 and 2, it's minor, and then it starts to increase starting with decile 3. The impact is more significant in the lower quality firms in the higher deciles. You can see the 8.4 increase in decile 9, and then a flip to a decrease of 2.9%. So a lot of variability in the lower decile firms is reflected in this data. The final hypothesis 3, there is no difference in the cost of debt effects on the separated innate and discretionary components that I touched on. The regression results show that the R value of 0.607 is a strong linear relationship, stronger than the base model and the prior with crisis included. And the R squared, it has more explanatory power at almost 37% compared to 35 and 24. So increasing and explaining these relationships as we add these variables. The p-value shows statistically significant for both the innate and the discretionary. And the T statistic also very strong at 12.76 for the innate and 10.31 for the discretionary. Both the innate is the strongest, which indicates that it has the most explanatory power. And that the cost of debt movement for a firm is primarily driven by the operating fundamentals that were touched on and included in this calculation. Size, variability in cash flow, sales, their operating cycle, and the incidence of negative earnings. Just as a reminder, those are the drivers to those fundamental values. And this is important to note because lenders will tend to value this more than the discretionary AQ movements, as those are assumed to normalize over time. So this is weighted much more heavily in debt decisions. Based on the results, the null hypothesis is rejected. There is a differential impact between the subcomponents of accruals quality on the cost of debt. Summarizing the data analysis and findings, the investigation involved using the descriptive statistics, inferential statistics, and regression analysis discussed. It also showed moderate to strong linear relationships for cost of debt and AQ based on the R values, R squared, and adjusted R squared observations, increasing between the different regression models that were shown with the additional variables. Innate AQ was the strongest predictor of cost of debt compared to what I call the baseline AQ and discretionary. And based on the study findings, all three of the null hypotheses were rejected and the alternative accepted. Chapter 5, the discussion of study results. So interpreting the findings for hypothesis 1, again, there's no difference in the cost of debt. It stated that there was no difference in the cost of debt for firms with poor AQ versus good, but the findings confirmed there was a difference. They confirmed that there's a positive linear relationship, which was explained 24% of the variation, with a moderate explanatory power. However, the p-value and t-statistic both showed that the results were statistically significant. And then calculating AQ into the deciles also provided the further explanatory power and confirmed that firms with higher AQ have a lower cost of debt at that average of 2.1% compared to 7% for the low AQ firms. Hypothesis 2, summarizing, assuming that there was no cost of debt difference during periods of crisis. We confirmed that there was, even though it was minor, rejecting the null. But we also discussed that there is a benefit to firms during times of crisis as they realized a smaller variation compared to the lower AQ firms, which had a lot more significant variability in their cost of debt. Interpreting findings for the hypothesis 3, this stated there was no difference in the cost of debt effects based on innate and discretionary, and this was rejected as we did prove that there is a difference and that the innate is significantly higher at the 12.76 t statistic. So while discretionary was significant, the innate is a much more powerful predictor. The implications for the study, investigating the impact on the firm's financial transparency on its cost of debt, specifically within the automotive manufacturing supplier industry, provided the opportunity to offer actionable insights to stakeholders within the industry, as I've noted here. Companies that maintain higher levels of AQ can significantly lower their cost of debt, potentially having an economically meaningful impact on the firm and freeing up resources that can increase firm value through reinvestment in the business or improving liquidity. This suggests that the firm should prioritize transparent financial reporting as part of their overall corporate governance within the firm and as a key component of financial reporting practices, which would include their disclosures. And finally, based on the finding that the cost of debt difference between high and low AQ firms widens during periods of crisis, it indicates that higher AQ firms could be considered less risky by lenders and provide a potentially competitive advantage to them when they may need it during times of crisis. Limitations, ethical considerations, and position statement. So while the single industry focus was the goal of this study, it did limit it to some extent by focusing on just a subset of the top automotive manufacturing suppliers. It was a smaller data set. A conflict of interest was not present during the research. However, I have previously worked for publicly listed companies such as TRW, TI Automotive, and Adient. And ethical considerations for the study were minimal, as there were no human subjects involved, and the study utilized publicly reported information through the WORDS CompuStat database. And it is assumed that the data retrieved from that source is accurate. Future research opportunities. The potential to investigate the different cost of debt results observed by country. There was a statistically significant difference, or a significant difference in the cost of debt for the global firms that I showed in the beginning. The cost of debt for Japan was 1.8 compared to the US and Brazil at 7. So an opportunity to investigate that to determine if there's a competitive advantage to firms based on their location. Future research could also investigate the other measures of transparency that were shown from Barth and Schipper, such as the market-based and analyst-based, either within the automotive supplier or an expanded data sample. Also, the potential to introduce the growing and evolving additional transparency measures, such as corporate social responsibility, environmental, social, and governance, sustainability in general, and integrated reporting. And Garcia Sanchez and Noguera Gamez have done some studies on that already, again, on a larger data set. And then as firms continue to come under pressure to share more information, not limited to financial, but also these other transparency measures, future research could examine the trade-offs in establishing an optimal transparency level. At what point is higher debt okay if you're willing to absorb sharing less information? And that's been discussed by the author Dye in 2001. So that ends my presentation portion. Again, a huge thank you to my committee for their support and guidance during my dissertation journey, Dr. Perez, Dr. Bateman, and Dr. Parlett. And I believe we're ready for questions now.
Thank you very much, Kristine, for your presentation and your thoroughness in explaining the results of your findings. At this time, what I'd like to do is turn it over to the committee for some questions and answers. Dr. Bateman, Dr. Parlett, is there any questions that you may have for Kristine? Any one of you could go first.
Yeah, I'll go ahead and jump in here. Number one, and thank you, Kristine, for all the work you've done, and congratulations on getting this far in the process. I just have one question, really, and it has to do with the selection of the variable cost of debt, and what your thought process, because I wasn't here when you were starting, and it jumped in later in the process. What your thought process was in choosing that variable, as opposed to choosing cost of equity or total cost of capital.
And
I'm not suggesting it was wrong. I'd just like to know your thought process.
That the original scope was total cost of capital. It is touched on in the research that I've referenced. Cost of equity, I think, was much more complex based on the models that I observed. So I wanted to do something that I knew I could measure. I could have added that to future research to look at the cost of equity, but it did use multiple level CAPM models that were very complex. So it is part of the story for sure. But again, going back to choosing the accounting standard, I think it makes it more comparable. A lot of different sizes, and we're on a lot of different indices with the global data set, but all of the firms had debt. So yeah, I think it's a valid question, and it has been explored. I just there was one of the studies that I looked at actually did both, but they did it separately. So that was kind of one of my approach. I could do debt now and then explore equity at a future study. Okay,
so you already answered my second question was, is this something that you could look at in future research? It sounds like you've already thought about it. So yeah. Thanks a lot. That's all I've got right now.
Okay.
Worked on this together for a while, so a lot of the issues were with your help and hard work answered previously. So that's all I wanted today. Thank you.
Thank you very much, Dr. Bateman. Dr. Parlett?
Yeah, sorry about that. I got kicked off. I had to get back on. I think I come back at it maybe from a application perspective of being a longtime finance person in similar companies. They're not normally willing to be transparent, right? So how do you think this study lands, or how do you think it can be used, right? I mean, because most of the time they're going to report what's the bare minimum. And, even at all levels of a company, if you're even at a plant, right, you filter what you tell the next level up, and it just goes all the way up to the top, right? So
right.
I think it shows, that the transparency has a benefit, but how do you think it lands in your subset of companies, right? Because my experience is they don't really want to be transparent.
Exactly. I think that's why that optimal level was an interesting topic for me, right? Like, you're willing to incur a higher cost of debt to not have to share everything. The more you share, the more questions you get, right? Which is always, right. And that that was touched on in the disclosure lit review, right? Is voluntary. You don't voluntarily tend to share bad news. It's usually the good news. And we don't like to share forward-looking statements either. Most companies don't. So I think that trade-off is a really interesting, companies are probably carrying a higher cost of debt because of that, right? Because of the more you share, the more questions you're going to have. And it's, we're restricted by systems to some extent too, and availability of data, even within the own firm. So I think, again, I started this study when I was no longer with a public firm. I was with private equity, and it's harder to get information for private firms, but it's very interesting the conversations we have with banks and the amount we share. It's similar but different. You don't want to overshare because you get more questions, but you try to balance the information. I think I can see more closely the impact it has on your debt, I guess.
Yeah, I've seen the same difference, right? I've left the public side too, and it's very markedly different. I guess the only other one I had too is this, and I know you touched on it on the macroeconomics, right? Is how much of that do you really believe impacted the results, right? Because the interest rates in some cases, the Fed rate went to 0, right? Does that skew your findings at all? And what do you think?
The fact that they moved together made me feel more confident that it didn't skew the data. It was interesting that it wasn't addressed in any of the other studies. Some did. They didn't really talk about it in the studies, and my focus was really on the crisis period. It was interesting to me to see that it moved down the entire time, but then when I looked at the LIBOR rates, it made sense. And we all know that they went down to 0, basically. So I don't think it skewed the information, and that's why I tried to focus on the movements and the variability within the groups, right? To say, okay, how much, it moved 50%. There was a lot of volatility in the crisis period, which was what I was trying to explore. And it proved that happened. I don't think it skewed the data. It seemed to be consistent.
Okay. Then maybe my last one, more general. So what surprised you the most with your results? And would you do anything different? Or did the results kind of come to what the prior research and what you expect?
I think they were in line with the prior research, so I don't think I had a lot of surprises. I was slightly surprised that I lost as many companies as I did. I was hoping to have a slightly larger data set, but the sample size was the G power told me that it was a good sample size, and it was nice to work with a smaller data set. So that was maybe the surprises, that some of the companies did fall off, but I think that also was explained by the variability in the data set and how the automotive market works in general. That these firms fall off and they don't stay around for long sometimes, or they get absorbed. So I don't know that I was surprised, but that was interesting to me. Yeah, to kind of see it in black and white in the numbers.
Okay, that was all I had. Thanks.
Thank you.
Thank you very much, Dr. Parlett. Kristine, I just got a couple questions for you that I just, if you don't mind sharing, and this is regarding the your methodology, your quantitative longitudinal study that also used linear regression, but I wanted to focus on the longitudinal portion of it. Now, in a longitudinal study, the potential for changes in external economic conditions or even regulatory environments over time can impact the results. Could you share with us how you controlled for or accounted for such temporal factors in your analysis, and what steps did you take to ensure that the observed effects on a firm's cost of debt were indeed attributed to financial reporting transparency?
Well, I think that's where the numerous variables came into effect, right? So it was making sure that I was using the right control variables for that duration of time. And I think, as I noted, this was consistent with the other studies, which ranged an average of 14 years. They went from 7 to 32. So there was other studies as large as this 30-year period. So controlling for that standard deviation sales, using the standard deviations, and also scaling the variables. And I think I mentioned it very briefly. The majority of variables were scaled by total assets. So taking some of the noise within the groups out, which may have changed due to those conditions that you just mentioned, the longitudinal going over 30 years. So I think the use of the scaling of variables and the standard deviations addresses some of that noise that they're going to move over a long period of time. And then using the empirical variables from the study for the financial metrics that truly impacted the cost of debt, right? The leverage, the interest coverage, I think were the appropriate variables to capture
Okay.
that.
All right.
Did that answer the question?
Yes.
Okay.
And my last question is, now that you've completed your defense and you've completed the study, knowing what you know now about the process, what would you do differently? What would you change if you were to conduct this study again in the future?
I don't know that I can change it, but getting your hands on the numbers and starting to look at the data was very meaningful to me. But you have to follow the process, right? So I don't know that I could change that before, but trying to understand. I don't know. I wanted a small data set, but I'm very curious now to a larger data set. So, the numbers are what was the fun part to me. So just maybe understanding those more going in. I wasn't surprised. I was very consistent with the prior studies, but just understanding that data collection and, use of the statistical tools. Now that I've got that behind me,
Okay. Well, thank you very much, Kristine. At this time, what I'd like to do is allow our distinguished faculty and guests to ask any questions. Dr. Itoma or Dr. Lyman? Dr. Itoma, you got your hand up. You had a question.
He's quick.
Hello, Kristine.
Hi,
Great
Doc.
presentation. Can you all hear me?
Yes, I can hear
Awesome.
you.
Yep.
Yeah, great presentation, Kristine. I'm so glad that you made use of Jamovie. Yay!
Oh, it was wonderful. Yeah, it's good.
Awesome. Yeah, I had two questions for you, but Dr. Perez has asked the first question, so I will move from the methodology, which is a longitudinal study.
Okay.
But so my second question is, did you consider using fixed effects or random effects models for your analysis? If so, which model did you present, and what was the rationale behind this choice?
You got me on that one because I remember looking at it, but I don't have that right in front of me. I believe it was a fixed model. I would have to check Dr. I. I'm trying to picture the Jamovie screen in my head. I apologize.
All right, because I think it's very important that we know if it's a fixed effect model or if it's both or that you presented, because this choice, so if it's a fixed effect model, this choice could be based on the assumption that there are unique characteristics of, say, for example, each supplier that could affect the cost of debt, you know, and so maybe the fixed effects could help control for unobserved individual effects, for example. And
Right.
then if it's a random effect, there are other assumptions that holds in terms of using a random effect, as it could allow for time invariant variables in the analysis to be included, you know. So I think that it would be nice for one in your chapter 4 to define if it was a fixed effect model or it was a random effect model. That's just one thing I observed.
Okay. I can define. I did. That would. Yeah. I can confirm that for you.
That's all I have for you. Great job.
Thank you very much, Dr.
Thank you.
Atoma. Dr. Lyman?
So normally at this point, I have 4 questions. But you have done, you shot the lights out in terms of covering the waterfront. So the 4 that I would normally ask would be, the first one would be an operational definition of transparency, which you nailed.
Okay.
The second one would be the percentage of the variance accounted for by the variables that you chose. And you did that. It's 24% depending on the model. That's very cool. That's significant. That gives you that much control, potentially. The third one would be, okay, if you were hired as a consultant by a financial organization and you were making the pitch about transparency, what would you tell them? And essentially what I heard you saying, I heard the discussion from the 2 seasoned pros from the industry, is it's a fine line to walk between what you want to share and what you want to pay. And that makes perfect sense.
Yep.
And then the fourth question that I always ask, and Kevin's already asked it, is were there any surprises? And it doesn't sound like there really were. You have the benefit in some regards of a previous study that you were able to scale down to become more finite, which is pretty cool. But my hat's off to you, girl.
Thank you. Thank you so much. I appreciate that.
Thank you very much, Dr. Lyman. Lisa, do you have any questions?
Yes, I would love to ask a question. Kristine, I'm just curious, I've got a 2-part question. Number 1, what do you believe is the most significant, or let's not use the word significant, what do you believe is the most impactful finding? And then the second part of the question is, like, what will you do with these findings next? Like, you're very passionate about the study, right? So now that you have your research done and you have, significant findings, like what will you do with them?
So I guess, yeah, number 1 is, oh gosh, I lost it. What was your
finding excites you the most? Like what do you think is most, like the single most important finding or impactful finding from your study?
I think my goal was, there was a perception that there was this cost impact to a firm, and it was confirmed. It was a little more significant than I thought it would be, right? My range just for automotive specifically was almost 7% between the low and the high firms. So I was surprised at the scale, which to me, means it could really have an economic benefit to trying to find a balance with firms. So I hope to share this with my company since we are private. And as Kevin and I discussed, like it really could impact us more as we talk to our banks. So hopefully share it with my leadership team and let them, see the insights and see what questions they might have. Like, well, what does it mean to be more transparent? What kind of disclosures can we do? We're not public, so we don't have to file, but how do you share that information in the right way to try to impact your cost of debt? So somehow try to find a way to use that and get it into people's hands that can see an economic benefit. That would be how I would want to use it.
Thank you. Nice job.
Thank you.
Thank you very much, Lisa. If anyone has any other questions, I'll just step back for a second. If anyone wants to ask one last question. Okay, if we're good, this concludes Kristine's defense. What we're going to do now is, Kristine, if you stand by, the committee and I are going to go to another Teams meeting link. It should be in the calendar. We will deliberate, and then we will return and then give you our decision. Okay?
Okay.
All right. Okay,
Sounds
Kennedy.
Thank you so much, everyone.
All right,
Take
we'll be
care.
right back. You will be right back.
Bye.
Thank you very much.
Okay.
And
Am I supposed to stay in or?
Nope. We will go ahead and end this.
You have a
And
separate
you're gonna,
link.
they'll let you know when you're ready to hop into the second link, and then we'll send an announcement to the audience so they know the result of the deliberations. Thank you, everybody. We'll be ending the meeting now.
Okay, thanks.